My name is Farhan. This video will show you how to solve question number 5 from the 2023 past exam. This question requires you to prepare the ledger accounts for inventory and GST clearing. You're also required to prepare the operating activities section for the cash flow statement. If you want to ace your exams in November and you need help with tutoring sessions, make sure to check the links in the description to book a call. With that being said, let's get started. Grads Art Supplies is preparing its cash flow statement for the 6 months ended 30 June 2023. Sales and purchases are all made on a cash basis. The income statement for the 6 months ended 30 June 2023 showed the following. So here you can see we are given the sales, the cost of goods sold, the gross profit, the inventory write down, and different types of expenses. We are also given the closing balances from 6 months before at 31 December 2022 for inventory, prepaid rent, and GST clearing, and also the closing balances today at 30 June 2023 for inventory, prepaid rent, and GST clearing. A GST settlement was also paid to the ATO on 30 June. We also have other GST payments for the period, which is totaling $20,900. We are required to prepare the ledger accounts to find out the cash flow for inventory and GST clearing. So on the right hand side, you can get to see the workings that I have done. So we're going to start with inventory first. Now, inventory is a current asset account for the business. All assets by default are debited, which means when assets go up or when they increase, we debit it. When assets go down, we credit them. Also, the opening balance of all assets must be on the debit side within the ledger account itself, which means the closing balance of the asset must be on the credit side. So here we have started with the opening balance on 1st of Jan 2023, and that is $60,000. So where did we get the $60,000 from? So based on the additional information that's given here, you can see the closing balance for the previous 6 month period ending 31 December 2022 for inventory was $60,000, which means this gets carried forward as the opening balance is in the new financial period starting 1 Jan 2023. So Jan 1, we are showing the opening balance of $60,000. And the reason we're showing it on the debit side of the ledger account is because assets by default are debit. When they increase, we debit them, and the opening balance of the assets are always on the debit side. When they decrease, we credit them, and the closing balance of the assets are always on the credit side. So now that we have taken care of the opening balance, we also know the closing balance given at 30 June 2023, which is $64,000. And just a while ago, we have discussed that the closing balance of the asset should be shown on the credit side of the ledger account, which is this side. And you can see on June 30, I've included the closing balance to be $64,000 on the credit side. So now that we have taken care of both the opening and closing balances, let's see what else we have to do. So if you check the income statement, you'll see the amount given for cost of goods sold, which is $170,000. Now, what does cost of goods sold or cost of sales mean? This simply refers to the cost that the business paid to purchase the inventory from its supplier. So in the books of the business, this inventory is recorded at an amount which the business paid to acquire from its supplier. Okay, so if we have made some sales during the year, we have got rid of some inventory that we had in the books. And whatever we got rid of is what we refer to as the cost of sales. So if we had got rid of any inventory, that refers to a reduction in the amount of inventory that we hold in the business. Inventory is an asset. So if the inventory is reduced because of the sales that we have made to our customers, that means assets are going down. So if the asset in terms of inventory are going down, then we have to credit that, right? So within the inventory ledger account, you will see that on the credit side, I've included cost of goods sold of $170,000. So the exact date should be June 30, which since we have already written here once, you don't really have to write it here again, but you can write it if you want, it doesn't really matter. So again, if you want to write June 30 here, so for the period ending June 30, 2023, we had cost of goods sold of $170,000 taken from the income statement, which results in a reduction for the balance of inventory and therefore is shown on the credit side of the ledger account for inventory. Now, we also have another thing relevant to inventory, which is the write down. So on the left-hand side of the screen, you can see right underneath the gross profit, we have less inventory write down of $4,000. So inventory write down of $4,000 in this case could be referring to obsolescence or outdated stock that the business held. And therefore, the business is incurring some loss in that inventory due to this obsolescence or outdated stock. So the amount is $4,000. So inventory write down refers to a reduction in the balance of inventory. So if inventory is going down, which means assets are going down, what do we have to do? We have to credit it. So that is why within the inventory account, you can see that on the credit side of the ledger account, we are showing inventory write down of 4,000 to reflect the reduction in the amount of inventory that we have in the business. All right. So once we have taken care of all the information, the highlighted amount here is what we had to calculate ourselves based on the requirements of the question, which asks you to find the exact cash paid to purchase the inventory. So how do we get this number? So what do we do is add everything on the heavier side. So you can just quickly scan through and you will know if you were to exclude this, the heavier side was the credit side. So you add everything on the credit side and you get $238,000 in total, which must be the total on the debit side to make sure the fundamental rules of accounting apply. And if you take away the opening balance of $60,000, then the amount that you're left with is $178,000 on the debit side, which is referring to the amount that we have paid to purchase inventory. The reason we are writing back here is because the second line of the question explicitly mentions sales and purchases are all made on a cash basis. So which means whatever purchases we have made, the funds had to go out from the bank account, right? So that is why on the debit side, we are writing back of $170,000. You need to be very careful in exam not to write accounts payable if the purchases have been made on a cash basis because you will lose marks. So once you find the missing figure, which is $178,000, this refers to the inventory that we have purchased by paying $170,000 in cash, and that is for the period ending June 30, 2023. So the first ledger account is now taken care of. Now let's look into the second ledger account for GST clearing. Now, GST clearing has to do with the GST that the business has paid out and the GST that the business has collected. So when will the business pay GST? Normally when it makes purchases relevant to expenses or when it makes purchases from suppliers. When will the business collect GST? When it makes the sales to its customers. Okay, so what we have to do is check the GST clearing closing balance for the previous 6-month period ending 31 December 2022, which is given in the question. Under the additional information here, you can see GST clearing at 31 December 2022 had a balance of 3,000 credit. So a balance of 3,000 credit simply refers to the current liability that the business had for GST, an obligation which it needs to pay off the ATO at 31 December 2022. So this would become the opening balance on 1 Jan 2023 of $3,000. So the opening balance here is shown on the credit side. This is because it refers to a liability, it refers to the obligation, it refers to the amount that the business owes the ATO on 1 Jan 2023, and that being $3,000. Always remember, liabilities by default are credited, which means the opening balance of the liability should always be on the credit side. If liabilities increase, they should be on the credit side. If liabilities decrease, they should be on the debit side, which also means that the closing balance of the liabilities should be on the debit side. So this is the exact opposite to the treatment for what we would do for assets, as you had seen in the case of inventory before. So the closing balance in this case is zero, so we really have nothing to worry about in this case. However, we know based on this information here, which you can see I'm circling, our GST, which means our GST settlement was paid to the Australian Taxation Office on 30 June. As you can see here, all other GST payments for the period totaled $20,900. So within the ledger account, on the right-hand side that you can see, the amount that I have highlighted in yellow is the amount that we had to find out as the missing figure. So we're going to come back to that later. But before that, if you read the second line, it says all other GST payments for the period total $20,900. So if you are paying GST of $20,900, does that not reduce your obligation to the ATO? Yes, it does. So to begin with, we understand that we have an obligation on 1 Jan 2023, but now that we're paying $20,900 to the ATO, our obligation to the ATO is going down. So this means, in other words, that our liability is going down. So liability, when they go down, we have to debit them because the opening balance, as you can see for the liability, is on the credit side, or in other words, when liabilities increase, we credit them. Therefore, when liabilities decrease, we must debit them. So that is why you can see for the period ending 30 June 2023, we are showing $20,900 that we have paid for using our funds in the bank. The reason we're writing bank is because we have paid it. It explicitly mentions all other GST payments. So payments here referring to the cash outflow from the bank. So and that is $20,900 included on the debit side just because it represents a reduction in the amount of GST liability that we have to the ATO. Then on the credit side, you can see that for the period ending June 30, 2023, we have included 32,500. So if we are including this on the credit side, that means our obligation has gone up. So our obligation can only go up when we are collecting GST from our customers. So having said that, the customers are the people to whom we are going to sell, right? So if you check the income statement, you will see the amount given for sales, which is $325,000. We know the GST rate is 10%, which means the GST that we're going to collect on the sales is $32,500. Also, you can see on the second line, it clearly mentions both sales and purchases being on a cash basis. So therefore, within the GST clearing account, on the credit side, you can see for the period ending June 30, 2023, I've written bank, which refers to the collections for GST from customers in terms of cash, and that is $32,500, which is what we have calculated based on applying 10% to the revenue figure that's given in the income statement. Now, let's just assume that we do not have this figure given to us and we need to balance the GST clearing account. So how do we do? So you can quickly scan through the ledger accounts without having this thing in place, and you will see that the credit side is the heaviest side. So we add everything on the credit side, which gives us 35,500, which must be the total on the debit side to ensure the fundamental rules of accounting apply. And from there, if we subtract 20,900 that relates to the other GST payments, then we are left with 14,600 as the GST settlement that we had paid to the ATO. So you can see that we are given here two lines for GST, and these two lines refer to two different transactions. One refers to a GST payment of 20,900, which is what you can see here, and the other refers to the settlement. So the settlement is basically the net amount that we owe to the ATO that we have to pay eventually for the period ending 30 June 2023, and that in this case is 14,600 as the missing figure. And we have written bank here simply because we are paying. And again, why is it on the debit side? This is because this refers to a reduction in the obligation that we have. And That is the main reason behind why the balance is zero, because we have settled everything that we owe the ATO at 30 June 2023, which is generally the financial period for Australian companies and Australian businesses. Okay, so that's how we take care for inventory and GST clearing account. Now, the second part of the question wants us to prepare the operating activities section of the cash flow statement for the 6 months ended 30 June 2023. Now, anything that has to do with cash inflows and outflows for the day-to-day operations of the business is what we're going to be including here. So we're going to first start with cash sales, which is a cash inflow, and that is straight from the income statement for sales, which is $325,000. We also know that we have received 10% GST from our customers, and that is 32,500. Then we are including inventory purchases because the question explicitly mentions both sales and purchases to be made on a cash basis. And that is $178,000 within brackets, which refers to a cash outflow. Where did we get this $178,000 from? If you recall, we got this from the inventory missing figure when we did the ledger accounts, and that was $170,000 that we purchased, referring to the additional inventory for the period ending 30 June 2023. Then we included the GST settlement, which is 14,600 based on what we just calculated a while ago. And then we also included the other GST of 20,900 that we had paid to the ATO. Then we have prepaid rent here. So the prepaid rent calculation is what I want to show you separately. So I'll just scroll down and I've prepared a ledger account for the prepaid rent. Now, prepaid rent is a current asset. We understand that. Why do we call it prepaid? Because rent has been paid in advance. That is the main reason behind why we call it prepaid. So if you check the additional information, you will see that the prepaid rent balance at 31 December 2022 was $4,000, and the balance at 30 June 2023 is $5,000, which means this $4,000 from 31 December 2022 will now be the opening balance on 1 Jan 2023. So if you check the workings that I've done for prepaid rent, I've shown the opening balance. I've just written OB in short. So, and that is $4,000, which refers to 1 Jan 2023. And why are we including this on the debit side of the ledger account? This is because prepaid rent is an asset. And assets, by default, should always have an opening balance on the debit side. And then we are showing the closing balance on the credit side of 5,000, which is the balance at 30 June 2023, based on what's given in the question. So the amount that I'm just highlighting is the one that we have to find out as the missing figure. But what about the rent expense that I have included on the credit side of 24,000? Where does that come from? So that comes from the expense section in the income statement. So rent expense of 24,000. Now, I want you to take a few seconds and understand why is rent expense shown on the credit side of the prepaid rent account. If you got this correct, so the main reason should be prepaid rent is an asset account, right? So prepaid rent refers to the economic benefits that the business is yet to consume. But if the amount has already been expensed, this refers that the business has already consumed some of the benefits, right? So that is why if the business consumes some of the benefits or all of the benefits, for example, then what's going to happen to the prepaid rent, which is an asset account? It's going to decrease. So that is why on the credit side of the prepaid rent account, we have shown rent expense of $24,000, which shows the amount that we have consumed in terms of rent and how it reduces the overall balance of the asset. And that is why we are showing it on the credit side to reflect that reduction. Okay, so the total for everything on the credit side is 29,000, which must be the total on the debit side. If you subtract the opening balance of 4,000, you get 25,000. I missed 10 here. So 25,000, and that is the amount that we have paid for new prepaid rent in the financial year ending 30 June 2023, and that was $25,000, out of which the expense was $24,000 at 30 June 2023. So this amount that we have paid for using our funds in the bank, and that being 25,000, is referring to a cash outflow because we have paid for it, right? So that is why for prepaid rent, we are going to show 25,000 within brackets to reflect the cash outflow. Then we have wages, and we have included in 43,000 as a negative straight from the expense section of the income statement. This is because we really do not have any accrued wages. So we don't really have to worry about anything. The same thing goes for administration expenses, and that is 6,000 shown as a negative amount. We are not including depreciation because it's a non-cash expense. Depreciation simply refers to the loss in the value of an asset as it gets utilized over its useful life to help the business generate more revenue. So it's a non-cash expense and it has nothing to do with cash inflow or outflow. So we are not including that here. So then what you simply do is find the total of all the cash inflows, which is 357,500, and then you find the total for all the cash outflows, which is 287,500, and I've kept that in brackets to reflect the outflow. So once you subtract 287,500 outflow from the inflow of 357,500, you get 70,000, which is a surplus. Because this is a surplus, we write net cash flow from operating activities and to reflect that surplus, and that is $7,000 in this case. Okay, so we have taken care of part A and part B, so let's move on to part C. The accountant tells the owner that the operating activities section of the cash flow statement often provides more important information than the income statement, although the differences are not as much for your business given you buy and sell for cash. Explain the accountant's comment using an example from the information provided. Okay, so how can we answer this question so that we can get 4 out of 4? First of all, if I was to calculate net profit, how would I derive it? I would simply take all the revenues that the business has earned, and then I would subtract all the expenses incurred. The expenses in this case, as you can see, are rent, wages, admin expenses, and depreciation for fixtures as well. On the other hand, if I was to find the cash flow from operating activities that is strictly relevant to the cash inflows minus the cash outflows from the regular operations of the business. As we have already discussed a while ago, depreciation is a non-cash expense which isn't part of the cash flow statement operating activities, but it is part of the net profit calculation. Now, we calculate net profit on an accrual basis, which simply refers to the fact that the revenues need to be earned and the expenses need to be incurred. If I was preparing the cash flow statement, I could be including revenues that we hadn't earned, but let's say we had received the cash in advance. For example, we hadn't delivered our products or services to the customers, but we did receive the cash in advance, and that should be reflecting in the cash flow statement as an inflow. But if we were to include that in the income statement, it would be wrong because we got the money in advance, but we hadn't delivered our products. So under the accrual basis assumption, this isn't really the definition of revenues being earned, right? Because we haven't fulfilled our obligation to our customer. We just took the payment in advance, and this is a liability for us. But in this case, for grants earned supplies, we know that sales and purchases are made on a cash basis. And as you have seen, net profit includes non-cash items such as depreciation and inventory write-downs, which are missing in the cash flow statement. Okay? The business is required to generate cash from regular trading activities in order to survive in the long run. And a business can often survive if they have losses, maybe for some time. But money is what we see as a tool. But if there is no cash flow, then it becomes an issue. For example, If we had received payment in advance from our customers, that would increase the cash that we have in the business, which helps us sustain a bit longer, even though we're delivering the products in a different financial year. Right. So that is where cash flow and the calculation for net profit becomes different. Furthermore, the net cash flow from operating activities should be the main form of sustenance for the business so that it can survive. And the net cash flow from operating activities that the business earns can be used to repay any cost of financing or any debt, which also could refer to the owner taking some drawings or money out of the business. Right. So as you can see, there are differences between how we calculate net profit and how we calculate the net cash flow from operating activities. So this is what you have to talk about. And when the question asks you to use example from the scenario given, you just talk about the inventory write-down, depreciation of fixtures being the non-cash items, which do not quite reflect in the preparation for the cash flow statement from operating activities. Right. So this is how you need to structure your response to get a full 4 out of 4 in this case. So that's all for today's lesson. I believe you found a lot of value in this content. So make sure to like this video and subscribe to this channel. And also, if you need tutoring sessions, be sure to check the link in the description. I'll see you in the next video.